Hi there. Discover how capital gains tax is calculated on inherited property and why probate values, timing, and accurate records can affect your tax bill.
Imagine inheriting a family home bought decades ago for £40,000, which now commands $450,000 on the open market. Your first thought is likely how to pay the tax bill on that massive £410,000 difference. The reality is that your initial tax bill on that inheritance is exactly zero. But there is a hidden trap waiting. If it takes 18 months to clear probate and find a buyer, you could suddenly face aggressive HMRC penalties and thousands in unexpected taxes. I'm a senior tax expert from Tax Accountant, and today we are looking at exactly how capital gains tax applies to an inherited property during that critical window between probate and the final sale. If you and your siblings are managing an estate, it is vital to clear up a common misconception. The UK does not tax the inheritance itself under capital gains. It taxes the time delay and any growth in value that happens after the date of death. Because the tax system actively punishes administrative delays, you need a precise, step-by-step financial plan to legally protect this legacy from unnecessary taxation. We start with a concept called the CGT uplift. When someone passes away, the legal base cost of their property automatically resets to its open market value on the exact date of their death. This is known as the probate value. Be careful here. HMRC can challenge this valuation years after the fact. Securing a professional RICS valuation right away is your best defense against a costly dispute down the line. Once that base cost is locked in, the strict rule of capital gains tax takes over. You only owe tax on the financial growth that occurs after the date of death. This chart shows how the math works in practice. If a property is valued at £400,000 at death, takes 12 months to reach probate, and then sells for $440,000, you are left with a raw gain of £40,000. From that raw gain, you can subtract specific allowable deductions. This includes the estate agent fees, the conveyancing costs, and any capital improvements, like an extension. You cannot, however, deduct routine maintenance or cosmetic repairs. If those legitimate selling costs add up to £10,000, we subtract them from our raw gain. Your taxable net gain drops to £30,000. Knowing the strict legal boundaries of these allowable deductions gives you the first lever to shrink the taxable footprint of the estate. Next, we have to look at the annual exempt amount. For the 2026 to 2027 tax year, the government has reduced this tax-free allowance to just £3,000 per person. If the estate executors sell the property directly, they are severely restricted. They only get a single £3,000 allowance, and the remaining residential property gain is taxed at a flat rate of 24%. To bypass that bottleneck, families often use a strategic legal tool called a deed of appropriation. This diagram illustrates how the strategy works. By signing a deed of appropriation before exchanging contracts on the sale, the executors legally transfer the beneficial ownership of the property out of the estate and directly to the individual siblings. Look at the math for a family with 3 siblings. Instead of one allowance, they now receive 3 separate £3,000 allowances, creating £9,000 of tax-free gain right off the top. There is a secondary benefit as well. If any of the siblings are basic rate taxpayers, their fraction of the remaining gain is taxed at 18%, avoiding the estate's mandatory 24% rate. Utilizing a deed of appropriation effectively shifts the tax burden. You move the liability away from a single, heavily taxed entity and distribute it across a highly optimized network of personal allowances. Once the sale completes, a strict timer begins. Beneficiaries have exactly 60 days to report the disposal and pay the estimated capital gains tax through HMRC's digital UK property account. A dangerous misconception is that the conveyancing solicitor will handle this return automatically. They will not. The responsibility falls entirely on the seller. Missing that 60-day deadline triggers an automatic £100 penalty on day 61, followed by accumulating interest on any unpaid tax. All the careful pre-sale legal strategy you put in place becomes useless if you ignore the post-sale administrative speed. Strict compliance is the final safeguard of your inheritance. To protect a property inheritance from heavy taxation, follow 4 strict steps. Lock in an accurate probate value, track every allowable deduction, use a deed of appropriation to multiply your allowances, and file your return within 60 days of completion. Managing an estate is emotionally draining work, but failing to plan for capital gains tax needlessly surrenders a portion of your loved one's legacy to the taxman. Figures reflect 2026-2027 rules. Always seek bespoke financial advice. For help with capital gains tax or a deed of appropriation, contact Pro Tax Accountant today. Hit the subscribe button to continue mastering UK tax compliance and protecting your personal wealth.